many ways, it's not surprising. I mean, things have been bouncing extremely hard over the past few months. So a bit of give back shouldn't be surprising. We've had some sort of mini lockdowns in bits of Europe, and expectations tend to get over extrapolated in one direction. And of course, we've also had a very strong euro in the last few months. So there's a bit of an impact there as well, as Europeans have to deal with that slightly higher currency, a more challenging export market as a result. So, yeah, I wouldn't read too much into it. I think it's sort of the classic ebb and flow of data. It never goes in a completely straight line.
And let's just pick up on that, because I think that's important when we think about how this data is being interpreted by investors. What do you think the match is currently between the economic data and the view on the European equity markets?
Well, I think the more the data is soggy, the more you're going to expect more stimulus. So actually, it works well for equity markets. So, in many ways, I'm sort of half flippantly the other day, but perhaps a degree of seriousness as well, making the point that perhaps the riskiest time for global equity markets is the day we get a vaccine and the day that governments feel they can't stimulate anymore and they've done their job. So, I think weak data adds to the stimulus case, and therefore, it's interesting the reaction we've seen this morning. I mean, equities, the knee jerk was down, and then they've rallied back from there in Europe. So, you're getting a softer currency in the euro as a result, and you're getting a bit of strength in the equity market, which I think is all good news for equities in the medium term.
Chris, I want to focus in on the labor market. In today's data, we've seen that services firms cut headcount for a sixth month and more sharply in August than they did in July. And you made an interesting point in your research about how, unlike the UK and the US, Germany and France don't have a furlough cliff coming up, or a potential furlough cliff, because they vowed to support workers for longer. Do you think that's going to serve those economies longer term, or do you think it could actually end up hindering the recoveries because you're keeping all these employees employed in potentially some sectors and some jobs that are becoming zombie jobs?
I mean, in the long term, it undermines the dynamism of an economy, because you're not getting the creative destruction at the speed you'd want it. As you say, you end up with zombie workers in jobs that perhaps they shouldn't really be there. So, the transition to e-commerce is a bit slower. All this sort of creative destruction that you want to see in a dynamic, high productivity growth economy isn't there. So in the long term, it's definitely negative. I think in the short term, it supports consumption. And we saw that in the GFC. German consumption didn't contract nearly as much as we saw in the likes of the UK and the US, where you don't have these sort of unending, never-ending furlough schemes. So, short term's helpful, adds to stability and less volatility in consumption. In the long term, it undermines the dynamism of these economies.